welcome you all to this video and in this video I will introduce to you about investment appraisal methods. Like we discussed in class that when any of the investment opportunity come to your hand, for example, you are a corporate finance managers and there are several investment proposal come to you. So you need some exact tool to help you to make a decision. So in terms of any investment projects, we need to understand whether we should accept or reject those investment opportunities. So in this video, I will introduce to you about those investment appraisal method. We need several of them to help you to make a decision. So the investment decision is the decision to commit the firm's financial and other resource to a particular course of action. Like we know that any of the investment that is a long-term commitment of the company. So we invest in some project because we think that it will contribute positively to the shareholders. Like we discussed in class that shareholder value maximization is a key goal of this subject. So this decision requires for us to estimate the future incremental cash flow from the project. So the important thing is that we need to quantify whether how much free cash flow will be the result of each investment projects. Then the value of this future cash flow in terms of the time value of money. So as you know that money in the different time means different in terms of value. So when you compare any amount of money, you need to compare it at the same point in time. Then later on, we also discuss about the degree of uncertainty associated with the future cash flow. So later on in this course, you will see sensitivity analysis and scenario analysis. So, in terms of the methods that widely used by the financial professionals include 6 items in the left side of this presentation. Net present value, internal rate of return, modified internal rate of return, profitability index, payback period, and discount payback period. Then each appraisal method this is very important because you need to estimate several things. Some of them is based on the estimation. Some of them is based on the past information. So we need to consider all of the future incremental cash flow from the project. Then later on you will know that when you look at the free cash flow construction, we need two things. The first one is about the sales and then do minus by any expense. Then you will arrive at the free cash flow. And later on in this course, you will see that free cash flow construction. You need to consider the value of this cash flow. It means that we need to think about the time value of money. And we also discuss about the risks. Okay, and then later on is an objective criterion. It means each organization, they have different criteria for exit. Okay, for example, some business payback period should be less than 6 years. Some of the business payback period should be less than 20 years, something like this. So it is vary in terms of each industry. So the first indicator is about net present value. It represents the present value of all expected cash flow. So you need to discount all future cash flow to the present value and net. The word net, it means that you minus it together. So present value of cash inflow minus the present value of cash outflow. And basically present value of the cash outflow is simply your investment in the first year. So you minus it together. And investment with a positive NPV increase the owner wealth. So once we understand about this concept, this is exactly the formula for this case. So net present value include the future cash flow and discount by the minimum required rate of return or K. Okay, and then in terms of the initial investment, that is the present value already, so no need to discount it once again. I will include with additional video to let you know about how we use Excel to calculate this thing, and it will help your life much more easier than calculate it manually. So the conclusion is that management main opportunity for web creation lies in its ability to implement and manage the project so as to generate positive net cash flow over the time. Okay, so the decision rule when you use NPV is that when you calculate any project, so once the positive NPV is mean that you should accept that project. And when you see the negative NPV, it means that those things destroy shareholder value. It means we need to reject them. But what sometimes you might arrive at zero NPV. It means that it does not make any difference between accept or reject. So you need to verify in the future whether it should invest or accept the project or not. Okay, but the first case is that you need to understand whether that projects rely to each one among 7 rationale that we discussed in the first class. So here is your example. Project A, you invest 40,000 and then there will be a following cash flow in year 1, 2, 3, and 4. Okay, so later on in the next video, I will show you how to calculate this. Remember that when we use NPV as a decision rule, we need to accept those positive NPV projects. Okay, so later on in your real life, you need to construct. Moreover, you need to conclude your understanding about each project and to give the management about your decision. Okay, so have a look in the next video. I will show you about calculation in Excel. Okay, but in this video, I will let you know about the concept. Then the second indicator is the internal rate of return. It is very similar to the NPV, but at this time we will trial and error until we find out some discount rate that bring the net present value to zero. Okay, so that is quite complex when you look at IRR, okay, or DCFU. Okay, so IRR is a discount rate in which you apply to the project and it brings net present value to zero. So in Excel, we will use a simply function to help us. So you should accept the project when IRR exceeds K, and K is your discount rate when you calculate NPV. So here is your decision rule. When you make a decision based on IRR, IRR should be more than K. It means that you should accept that project. In the opposite way, if IRR is less than K, you should reject that project. And if the IRR is equal to K, it means that the present value is equal to zero. So the first case, if IRR is more than K, it means net present value is positive. When the IRR is less than K, it means that net present value is negative. And when IRR is equal to K, it means that net present value is zero. Okay? So later on in the following video that I'm going to show you, we'll discuss about this case. So throughout every financial indicator, I will use project A and project B as our case study. Later on, positive NPV, IRR more than K is come together. Okay. Then the third one is the modified internal rate of return. That is a little bit more complex to IRR. It means that you calculate terminal value of the project by compounding forward or interim to the end of the project. Okay, so it means that throughout the project you might have any future cash flow. So you need to compile all future cash flow to the end of the project, and then you find a rate that equate that terminal value to your initial cost. Okay, so it means that this is two stage for MIRR. Okay, but in our exam or in our project, no need to do this. But you need to understand the definition, and actually this is not too complex. Okay. You compare to IRR that bring all future cash flow to present value, but MIRR you need to state. You calculate all future value to the end, and then compare that with the initial investment. Okay.